Normal trading versus private placement. All trading programs in the private placement arena involve trade with such discounted debt notes in some fashion. Further, in order to bypass the legal restrictions, this trading can only be done on a private level. This is the main difference between this type of trading and normal trading, which is highly regulated. This is a private placement level business transaction that is free from the usual restrictions present in the securities market. Usually, trading is performed under the open market, also known as the spot market, where discounted instruments are bought and sold with auction-type bids. To participate in such trading, the traders must be in full control of the funds, otherwise they lack the means buy the instruments and resell them. Also, there are fewer arbitrage transactions in this market, since all participants have knowledge of the instruments and their prices. However, in addition to the open market, there is a closed private market wherein lies a restricted number of master commitment holders. These holders are trusts with huge amounts of money that enter contractual agreements with banks to buy a limited number of fresh-cut instruments at a specific price during an allotted period of time. Their job is to resell these instruments, so they contract sub-commitment holders, who in turn contract exit buyers. These programs are all based on arbitrage transactions with predefined prices. As such, the traders never need to be in control of the client's funds. However, no program can start unless there is a sufficient quantity of money backing each transaction. It is at this point the clients are needed because the involved banks and commitment holders are not allowed to trade with their own money unless they have reserved enough funds on the market comprising unused money that belongs to clients never at risk. The trading banks can loan money to the traders. Typically, this money is loaned at a ratio of 1:10, but during certain conditions, this ratio can be as high as 21. In other words, if the trader can reserve $100, then the bank can loan 1B. In all actuality, the bank is giving the trader a line of credit based on how much money the trader commitment holder has, since the banks won't loan that much money without collateral no matter how much money the clients have. Because bankers and financial experts are well aware of the open market and equally aware of the so-called MTN programs, but are closed out of the private market, they find it hard to believe that the private market exists.